Welcome to this presentation about tax considerations for farmers in 2022. So my goal for this session is to talk about what it is that you may need to consider when you're filing your 2021 returns at the beginning of 2022. I'm also going to talk a little bit about tax policy matters that are pending before Congress right now, and just give you an idea of some considerations that have been on the table all year. And so I hope that this will give you a little bit of thought to consider as you go into tax appointments with your tax professional, but also give you some ideas as you plan your business year. So let's go ahead and get started with a little bit of a look about some really unprecedented events that we've had impact our tax world this year. The first one is really that COVID has led to some unprecedented social spending. We've really not ever seen legislative proposals, legislative policies implemented that have put so much money into the hands of citizens in such a short period of time. And of course, all of this was driven by the harmful impacts of COVID. And so if you're keeping track of zeros, it all started back in March of 2020 when COVID really became a thing. And at that time, we had a Families First Coronavirus Response Act, which was a piece of legislation that impacted all U.S. employees in a way that it required employers to provide paid family and sick leave. That was $225 billion right away. Then we had the CARES Act in March of 2020. Now, this was a $2.2 trillion proposal that was signed into law in March of 2020. And this was really sort of the mother of all COVID relief provisions. It's from this bill that became law that we ultimately got the Paycheck Protection Program. We had a first round of economic impact payments. We just had a number of provisions that were designed to stimulate the economy, keep Americans on the payroll, and help employers through the difficult times of COVID. Then in April, it was discovered that PPP really was a pretty helpful program to employers across the country. And so because of that, an additional $500 billion was put into the PPP program. So that was additional funding that was put in there. Then at the end of last year, we had the Consolidated Appropriations Act, which was an additional $1 trillion COVID relief package. And it was from this package that we got a whole nother round of Paycheck Protection Program loans and a whole assortment of additional COVID relief. Then in March of this year, there was a final piece of legislation that passed through Congress and was signed into law by President Biden. And this was the $1.9 trillion American Rescue Plan Act. The American Rescue Plan Act implemented a number of changes, but these changes to the tax code, which were really designed to put money again into the hands of Americans impacted by COVID, were implemented largely through the tax system. And it's for this reason when we file our 2021 returns, we do have to be aware of some of these provisions because they will be reconciled, they will be reported, they will be tracked on our 2021 returns. So I'm going to talk to you a little bit about how those provisions will impact your 2021 return. Let's talk specifically too about farmers and ranchers and the relief that was provided to this sector of the economy because of COVID. So farmers and ranchers were generally impacted by all of the provisions that were designed for all Americans. So most farmers and ranchers received economic impact payments. There were ultimately 3 rounds of these, but in 2021, there was the 3rd round that was paid out in March. And that was $1,400 per person, including dependents. So if you had college students who were still your dependents, you received $1,400 for those college students. If you're married, you receive $1,400 for yourself, $1,400 for your spouse. And I'll talk to you a little bit about how these payments impact tax liability, how they're reported on the 2021 tax return. Another really significant provision that was put into place with the Rescue Plan Act was a whole expansion to something we've had for a long time called the child tax credit. And the child tax credit was completely retooled for 1 year only with the American Rescue Plan Act. And I'll tell you a little bit more about that as we discuss how it will impact your 2021 return. We also had a very significant change to premium tax credits, which are tax credits or benefits available to people who purchase health insurance on the marketplace. Now, the marketplace is www.healthcare.gov. It is the government provided place where you can go out and you can purchase health insurance if you're not otherwise covered by insurance through an employer or through Medicaid or through Medicare. And for 2021 and 2022, the American Rescue Plan Act significantly increased the number of people who could get premium tax credits. So I'll tell you a little bit about that as well, because it could help some people be able to afford to purchase insurance. The other type of relief that a lot of farmers received in 2021 was a PPP loan. Now, some farmers received these loans in 2020, but in 2021, the law was changed so that farmers could calculate their loan in a different way and become eligible where they may not have been eligible for a loan in 2020. And so because of that, farmers received a number of PPP loans in 2021. And I'll talk to you a little bit about how those loans impact the tax return. Also, there were EIDL advances, EIDL loans that were made available to farmers as well as other small businesses. There's a credit that's quite important in 2021 called the Employee Retention Credit. If you have employees, if you pay employees as part of your business, make sure you ask your tax professional about whether you might be eligible for the Employee Retention Credit. It's a very generous credit that has been made available to, again, businesses that employ others, and it does not require significant impact really in order to be able to be eligible for this credit. So again, that is something to ask your tax professional about if you do have employees. Also, we've had Families First Coronavirus Response Act sick and family leave credits in 2020. In 2021, the Rescue Plan Act extended those through September 30th of 2021. Self-employed farmers can also qualify for this tax credit if they were sick because of COVID and were unable to work. They can also qualify for this credit if they were unable to work because they had to take care of a family member who was sick from COVID. This credit is also available if you had to miss work because you were sick from the vaccination or you had to miss work to go get a vaccination. So again, that's another provision that is available on the 2021 return for self-employed individuals. And if you want to talk to your tax professional about that, they can provide you with more information. Now, I wanted to tell you a little bit about how some of these general provisions will impact the 2021 returns that you'll be filing this year. And so the first one that we talked about was the economic impact payment. As I said, this is a $1,400 payment that was made to most Americans last spring. And so it was $1,400 per taxpayer, $1,400 per spouse, $1,400 per dependent. And these were very similar to the payments that were made in 2020. We actually had 2 rounds of economic impact payments that were paid out in 2020. The 2021 payment, however, was a little bit different in that it was more compressed in terms of who was eligible to receive it. And so, if you qualified for the first 2 rounds of economic impact payments that were made in 2020, you may not have qualified for the 3rd round that was paid in 2021 because the income cap was much lower. So this payment phased out for if you were married, incomes ranging from $150,000, it started to phase out. And if your income hit $160,000 and you were married, you did not receive an economic impact payment. Now, on the 2021 return, anyone who received an economic impact payment has to reconcile that with the actual recovery rebate credit to which you may be entitled on the 2021 return. Now, the great thing about the economic impact payment is if IRS made a mistake or they were looking at an old return and they paid you too much, the law says you don't have to pay that back. But if when you're calculating the recovery rebate credit, which is the credit that's available on the 2021 return, and you're actually eligible for more than what you received in advance through the economic impact payment, then you can take that extra credit on your 2021 return. So that's how that works. One word of advice is the IRS would have sent you a notice called 1444-C when you received your economic impact payment. If you receive that notice, you need to make sure to bring that notice to your tax professional, if you use one, when you file your 2021 return, because they will use that information to make sure that you received enough to offset the recovery rebate credit to which you're entitled. And if you did not receive enough payment in advance, then you'll be able to claim that extra credit on the 2021 return. Another very significant change for 2021 that will impact lots of farmers is the expansion of the child tax credit. Now, as I mentioned before, this is from the American Rescue Plan Act, and it was only at this time a one-year expansion. So it's only for this year that the child tax credit, which has generally been a $2,000 credit on the tax return, was expanded for this year to include children under 18. Now, in the past, it's included children under the age of 17. So for 2021, 17-year-olds are eligible and count to allow a parent to have a credit for that child as well. The other way the credit has dramatically expanded is it's increased from $2,000 per child to $3,000 per child if the child is age 6 through 17. If the child is under the age of 6, the credit is $3,600. And this credit came with it a kind of a complicated set of phase outs. So the whole credit in and of itself, the $2,000 credit, doesn't phase out until your income would reach $400,000 if you're married filing jointly. So almost all Americans are eligible for this child tax credit. But the increased credit was available to those who had income up to $150,000, and that increase began to phase out at that point. So if you have income, if you're married filing joint, above $150,000, you may still get some of the increase, but you won't get the entire increase. But nonetheless, everybody who was eligible for a child tax credit in 2021 was eligible for the entire amount to be refundable. Now, what that means is that even if you don't owe any tax at all in 2021, you'll get the entire credit back. So typically a tax credit is a dollar for dollar offset of tax liability that you have. A refundable tax credit says, oh, even if you don't owe any taxes, we are going to give you this money. So essentially what a refundable tax credit allows the government to do is to put money into the hands of people quickly and easily because it's administered through the system of the tax code, which is actually a well-worn system in terms of allowing the government to track where the money's going, to find people, and even people who have never traditionally filed a tax return have been encouraged this year to file something so that they can get this credit back. The other thing that's interesting in 2021 is we have always had an earned income requirement in order to qualify for the child tax credit. In other words, if you did not earn any income, if you did not work, you would not get the child tax credit because a tax credit really is supposed to offset tax liability. What the Rescue Plan Act did is say, well, we actually want this to be a payment, a social benefit to people who might otherwise need it, and so we're not requiring any earned income at all. And that's why some people, if you have not earned income, they will be filing returns to get this benefit, even though there's no income to report to the IRS. The other thing that the Rescue Plan Act did that impacted farmers all over the state and all over the country is to say, we want this money to go into the hands of families before they file the tax return in 2022. So what Congress directed the IRS to do was to calculate how much of a tax credit they thought each family would be eligible for based on the 2020 return that was on file. And then they would take that tax return that they calculated, that child tax credit that they calculated, and they divided it in half, and then they divided that by 6. And then for every month, for the last 6 months of the year, they deposited that amount of money into the bank accounts of families with children. And so what that meant was if a family had a child between the ages of 6 and 17, and their income was not above the phase-out thresholds on the 2020 return, they received a $250 check every month for that child. If they had a child under the age of 6, they received a $300 check per child every month from July through December. And then ultimately, even if you were in an income range where the enhanced child tax credit phased out, where you only were eligible for a $2,000 credit, those families received a $167 check every month per child. So these have been advance credit payments that have been going into the bank accounts of American families with children since July. And so what happens is when we file the 2021 tax return, these advance payments are going to have to be reconciled with the child tax credit to which you're actually entitled in 2021. So it's going to be interesting, and you're going to have to work with your tax professional if you were among the people who received these advance credits, because this is a little bit different than the economic impact payments that I talked about. With the child tax credit payment, if you were paid too much and your income is above $120,000 if you're married, you will have to pay the excess payment back. If you have income of $60,000 or less and you're married, filing joint, you won't have to pay any excess back. And if you're somewhere in between, you might have to pay a portion of the overpayment back, but not the whole thing. So it's going to be a little bit complicated, and it's really important that if you received a letter from the IRS called Letter 6419, which is supposed to be sent in January, you need to bring that to your tax appointment when you meet with your tax professional if you have someone professionally file your return on your behalf, because that will be required in order to report the amount of the child tax credit to which you're entitled and the amount of advance credits that you received. That's going to be required to reconcile the child tax credit on the 2021 return. In most cases, the amount of advance payment that you received was only a portion of the amount to which you'll be entitled on the 2021 return. So when you file the return, you'll still get the additional tax credit back. The situations that will be a little bit complicated will be those situations where there are shared custody arrangements. So if you're divorced and your former spouse shares custody of a child with you, and maybe your former spouse claimed the child on the 2020 return, then it was your former spouse who likely received an advanced child tax credit payment for that child in 2021. But ultimately, when you file your 2021 return, maybe you're the one who's entitled to the credit. Well, that will just mean even though you didn't get advance payments, you'll get to receive the whole amount come 2022 when you file that 2021 return. If your former spouse makes income above $120,000, the former spouse will have to pay the advance back. If not, if it's less than that, they may not have to pay it back at all. So again, it'll be a little bit complicated, but the key is to make sure you bring letter 6419 with you to the tax appointment that you have for the 2021 return. The other new provision that I think is really important for farmers out there to understand is that if you do not have health insurance, or if you're paying way too much for your health insurance, in other words, if you don't have employer-provided coverage, or you do not have an offer of coverage from your employer or your spouse's employer, if family coverage is not available through that route, then there is health insurance available on what's called the marketplace. Now, this was put into place way back with the Affordable Care Act, but this is a brand new provision for 2021 and 2022 in terms of an expansion of something that's been around a long time called the premium tax credit. And so if you go out to www.healthcare.gov, you can explore whether or not you're eligible for a healthcare policy. But the significant expansion that was made by the Rescue Plan Act was to say, even if you have income that is above what we call 400% of the federal poverty limit. And if you want to have some idea what that looks like, if you are a married couple and you don't have any children, then you would be at 400% of the federal poverty limit in 2021, for example, if you had roughly $69,000 of income. So under the law that was in effect before 2021, if you made 400% or more of the federal poverty limit, you were not eligible for a premium tax credit, which is a payment by the government to cover a portion of your healthcare premium so that you can afford to purchase it on healthcare.gov. Congress, with the Rescue Plan Act, said for 2021 and 2022 only, we are going to say that it does not matter what your income is, we will allow you to have a premium tax credit to pick up the difference of anything that you would be required to pay for what's called the second lowest cost silver plan on the marketplace, where you would be required to pay in excess of 8.5% of your household income. Any amount that you would be required to pay in excess of 8.5% of your household income would be picked up with a premium tax credit. And that can be paid in advance so that you never have to outlay the money and you can purchase insurance with that cost covered by the credit. So let me just show you an example of what kind of difference this makes to an average self-employed couple. For example, Tom and Carrie, let's say they're farmers who are married. Let's say they're each 60 years old. And that is the place where health insurance is very expensive, right? Because you're almost eligible for Medicare, you're not yet eligible for Medicare, but the policies are very pricey. And let's say that Tom and Carrie make $70,000 a year in adjusted gross income. And under the marketplace for a particular county in western Iowa, the cost of the second lowest cost silver plan is actually $3,324 a month. That's a very, very expensive premium. In other words, it would cost almost $40,000 a year if they would purchase that insurance. Well, obviously, somebody with $70,000 of income is likely not going to be able to afford to pay $40,000 a year for health insurance. And up until this year, they were not eligible for a premium tax credit to pay the difference. What Congress did is say, okay, we're going to reshift how much people are deemed able to pay for the cost of their own health insurance. And so the maximum amount that anyone has to pay, regardless of income, is 8.5% if you purchase your policy on the marketplace, if you purchase it on www.healthcare.gov. And again, you're not eligible to purchase a policy on the marketplace if you are eligible for other coverage. For example, employer-provided coverage or coverage through Medicaid, etc. So here's how this changed for only 2021 and 2022. And then if Congress doesn't extend the law, it will go back to the way it was in 2020 if nothing new passes. So for those 2 years only, though, the same couple, Tom and Carrie, 60 years old, $70,000 of income, same cost for the premium for this insurance policy. In 2021, they will only have to pay $5,950 a year if they purchase the second lowest silver cost plan, because the amount over 8.5% of their modified adjusted gross income will be picked up by the premium tax credit. It will be paid in advance through the premium tax credit. So again, that's a provision that has been put into effect by the Rescue Plan Act. That's temporary. It's in place for 2021 and 2022. Now, another item that's going to be important for 2021 returns are all of the payments that were made to farmers through other programs as well. So this legislation implemented the tax changes I just told you about through the form of tax credits, and those will be reconciled on the return. But many farmers have also received other benefits that were put in place by the CARES Act or the Consolidated Appropriations Act as well. And one of the biggest programs put in place for farmers specifically was the Cfap program. And this is the Coronavirus Food Assistance Program. Most of the payments went out in 2020. So those were Cfap 1, Cfap 2. But some farmers received payments for Cfap 2 in 2021. There was a reauthorization of some programs. There was a re-upping of the need to tell more farmers about Cfap 2 through the American Rescue Plan Act. And so because of that, some farmers received Cfap 2 payments in 2021. Also in 2020, there were COVID grants that were paid through the state of Iowa to producers. So some farmers received those. And then in the fall of 2021, some additional disaster payments called WIP payments were made to farmers. Now, these payments really stemmed all the way back to the derecho, but they finally got authorized, and those payments were made in 2021 as well. So one thing just to realize is all of these provisions are taxed just a little bit differently. So you have to understand how the program is taxed to know how it will impact your bottom line. So when you file the 2021 return, if you received a Coronavirus Food Assistance Program payment, if you received a Cfap payment in 2021, just know that that is fully taxable. It is considered just as any other farm program payment. So if you're used to receiving payments through PLC or ARC, it's taxed just like that. It's subject to SE tax, and it's reported as regular farm income. Now, the really great thing about the Paycheck Protection Program is those loans that were made through PPP that were ultimately forgiven. Those have no tax consequences. They are not income, and they do not reduce your deductions. So it's possible, given some late IRS guidance that we received, that you might have to report the amount of the forgiveness of your PPP loan on your 2021 return, but that will not subject it to tax. The bottom line is the forgiven PPP loan was not subject to taxation, and it did not impact your ability to continue to deduct any expenses that you paid using the PPP funds. The other benefit that some of you may have received in 2021 was the employee retention credit. Again, this is up to a $7,000 credit per employee per quarter in 2021. Now, it's no longer available for the fourth quarter because it was eliminated by the infrastructure bill that was passed in November. But for the first 3 quarters of 2021, if you had employees, it's possible you could be eligible for up to a $7,000 credit per employee because of the employee retention credit. Now, this credit is not income to taxpayers either, but it does impact the tax return because it reduces the wage deduction that you're eligible to take for those employees in the amount up to the credit. So for example, if I was able to take a $7,000 payroll tax credit for an employee, I would have to eliminate a $7,000 deduction for the wages that I paid to that employee. So that's how that impacts the tax return. If I'm a self-employed farmer who receives a sick and family leave credit because I had to not work for a time because maybe I had coronavirus or maybe somebody in my family had it, that is just a straight up tax credit. It offsets my tax liability for 2021 and it's not income to me. And then we had a new law that passed through Iowa this summer that said if you received a grant through the state of Iowa in 2020, those are not taxable for Iowa purposes. Now that was reported on the 2020 return, but I'm telling you about it now because the change in law did not take place until 2021. So if you received like a producer grant through the state of Iowa in 2020, and if you paid income tax on that grant, just know you could file an amended return for Iowa only and get that tax back that you paid because the legislature has deemed that grant money to be tax-free for the state of Iowa only. Those grants were still taxable on the federal return. Now, one other significant item that we're going to see with respect to 2021 returns, one significant issue is that as a whole, farm income is up this year. Many of you have had record yields. The prices are good. Going hand in hand with that, though, is that expenses are rising swiftly as well. So we have high incomes, but we have high expenses. And so there's just a couple of items that I want to talk to you about in terms of how do we deal with high income? Is there a tool that we can use to help us? And so the tax code is really full of special provisions for farmers. And the reason is because the legislature over the years, the Congress has realized that farmers are in a unique situation. They're in a unique situation where they're subject to ebbs and flow in their income. Sometimes they may have a spike, and then sometimes they may have a significant dip. And because our tax code is set up so that we have marginal tax rates, so if I have income up to a certain amount, it's taxed at a certain rate. But then if my income exceeds that, it's taxed at a higher percentage. And if it exceeds that, it's taxed at a higher percentage. So really, the tax code is set up to have little buckets that the higher your income goes, the more it's taxed. So what that means is it's much more beneficial instead of to have 1 year where your income spikes, you're going to pay a lot more tax than if you took that income and you spread it out evenly over 2 years, because both of those 2 years you will pay tax at a lower marginal tax rate. Whereas if you have a low tax rate this year, you'll have a really high tax rate this year if you have higher income, and you'll ultimately pay more tax. So the tax code gives us a great provision called farm income averaging that is available for farmers and ranchers. And if you have have a year of income that's higher than typical, you can use this provision to go back and spread the excess income out evenly across 3 prior base years, ultimately hoping to fill up those lower marginal tax rate buckets so that overall you pay tax at a lower rate than you would if you didn't use farm income averaging. This can be a very helpful tool. Again, it's something that a lot of people do not take advantage of. In fact, IRS has reported that there is an apparent underuse of this provision, that enough people aren't using it who would otherwise be eligible. So 2021 may be a year to really take a close look at farm income averaging. Another method that a lot of farmers look to say, well, I have high income, but I also need to purchase some equipment, or I need to build a farm building. I need to have an outlay of money to buy some capital expenditures that will help my business in the long run. And so when you purchase equipment, for example, for your business, you are allowed to take, of course, depreciation deductions over the useful life of that business asset. But the tax code has a couple of special provisions that are in place, and mostly these provisions are in place to help stimulate the economy. And so for 2021 and 2022 as well, we have, for this limited time, 100% bonus depreciation available. Now, what that means is it's an additional first-year depreciation deduction that essentially allows me to write off or deduct the cost, the entire cost of a business asset that I place into service during that year, 2021 or 2022. Now, it means that I actually have to place it in service. So if you were buying something in 2021 with the hopes of deducting it on your 2021 return and hopefully lowering your overall farm income, what you had to have done is actually place that item in service. And this was a difficult year to do that. So if you were ordering equipment, you might have been able to order it. You might have been able to pay for it. But the only way you're allowed to actually take the bonus depreciation in 2021 is if that item, is if that equipment is actually ready and available for a specific use. That means it has to be in your possession, ready to go. Now, if you purchased a tractor in 2021 and it was in your shed and it didn't need any further assembly, everything was ready to go, even if you didn't actually use that tractor, that qualifies as being placed into service. If you bought a combine that was delivered to your place at the end of 2021, even though your harvest was over and you did not run it through any beans or corn, that was still ready and available for use. It was still placed into service as long as, had you driven it out to the field, it would have been ready to use. But if all you've done is order that machinery and it's still on order, you haven't seen it, it hasn't come in, that is not ready and available for use, and you will not be able to take that deduction until it actually comes in and is on your farm ready for use. So just keep that in mind as you're thinking about what you're eligible to deduct in 2021. And again, as you're looking ahead to planning for 2022, we just have one more year of this 100% bonus depreciation. It's in place for 2022 as well. And then the way the law is written is it will phase out slowly over the next several years. And so it will completely phase out by January 1st of 2027. But that law was put into place with the Tax Cuts and Jobs Act that went into effect in 2018. And so 100% bonus depreciation is a very significant tax provision that allows you to take all of that depreciation at once. And one thing that's really important to understand for 2021 is the Iowa legislature fully coupled with federal bonus depreciation for the first time in a very long time for 2021 moving forward. So you can take bonus depreciation for items you place into service in 2021, and you'll be able to take the same deduction on your Iowa return. That has not been the case in the past. If you took federal bonus depreciation, you had to depreciate that equipment out over its useful life for the Iowa return. Two separate depreciation schedules, kind of a big hassle. But for property placed in service in 2021, moving forward, Iowa law follows federal law. And that has always been the case for Section 179. So Section 179 is an expense election. It's very similar to bonus depreciation, but the two provisions have some different possibilities. They're sort of useful in different situations. Section 179 allows you to immediately expense the cost of tangible personal property and some real property. So for example, Section 179 will apply to a single purpose agricultural building, like a hog barn. That's something that is helpful to think about as well. And the maximum deduction for Section 179 for 2021 is $1,050,000. And then if you have investment in assets above $2.6 million, your ability to take the Section 179 deduction phases out. But again, it's fully the same for Iowa purposes as well. And so I have this chart in the slides that you can also download, I believe, from the site that you're watching this video. And it will give you a list of farm assets and whether or not they're eligible for Section 179. It also tells you what is the useful life of that asset. So the column most useful for you is the GDS column. That's the General Depreciation System column. And if you're just wondering, if I were going to purchase drainage tile, if I was going to implement drainage tile, what is the depreciable life of drainage tile? And it's 15 years. But if I use Section 179, if I'm a farmer, I can expense that entire amount over the first year that I put it in, if it doesn't exceed the $1,050,000 limit. Also, if I'm a landlord who cash rents my farm ground, I can't take a Section 179 deduction. Again, we can't get into all the details as to why, but I'm not eligible for 179 in most cases if I'm cash renting my farm ground. However, I am eligible for bonus depreciation. So that is available to me even as a cash rent landlord if, for example, I were to put drainage tile underneath my farmland. So again, these are tools to discuss with your tax professional, but they can be very helpful tools. But the one thing to remember about rapid depreciation or about expensing that occurs in the first year when you place the asset into service is that you're taking a very accelerated deduction, right? So the idea of depreciation is that you get to write off the cost of the asset over the asset's useful life. And our system already, for the most part, accelerates these deductions. So for example, if I buy a new tractor under current law, it only has a 5-year life. So just regular depreciation would allow me to write off the cost of that tractor over 5 years. Well, it's not going to be a very good tractor if after 5 years it's not usable anymore. So that's already kind of accelerated depreciation. And so the idea of recapture is if I turn around and sell that piece of equipment before it's run to the ground, while it still has value, I am going to have to repay taxes on the amount of depreciation that I took over its useful life. So what happens is if I purchase a tractor for $100,000 and I write it all off with Section 179, and then I turn around and I sell it the following year, I'm going to have to pay ordinary income tax on $100,000 of income. Why? Because I took that $100,000 away from my income the year before, and I can't just turn around and sell the equipment. I have to actually, pay the piper. The tax code requires me to recapture that amount. And where that has become really significant is when the tax code changed in 2018 to say that no longer did you have tax-free exchanges for equipment. So, starting in 2018, we no longer had tax-free exchanges for farm equipment, for any personal property. And so that has meant that every time we go to trade a piece of farm equipment for another piece of farm equipment, we're actually selling that tractor. We're paying tax on the recapture, but then we typically turn right around, and with the new piece of equipment that we purchase, we offset the income from the recapture with the depreciation deduction or the Section 179 deduction that we get to take against the purchased asset. So they typically offset, but remember in 2023, we're no longer going to be able to take 100% bonus. We'll be down to 80% bonus, and it will continue to phase out. Now, you may be able to take Section 179, but there are a number of issues that come up because of the loss of the like-kind exchange. And so one of those is also just to consider the fact that you're not paying self-employment tax on the recapture, but the depreciation deduction is actually reducing your self-employment income. So if you're driving your self-employment income down to zero with depreciation deductions, think about Social Security benefits. Make sure that you're maybe using the alternate method of calculation to make sure that if you would become disabled, you have some type of benefit out there, that when you retire, you've paid into the system so that you do have some type of Social Security benefit available, or at least that you have retirement thought of. So that's a consideration that has really come to light because of the change in the law in 2018. One other income tax matter that I want to discuss with you briefly is a number of people in any given year, and especially with all of the natural disasters that we've been having lately, will receive a crop insurance payment, or they'll receive disaster payments because maybe they lost their crop because of a windstorm or a hailstorm or a drought. And the tax code takes this into account as well, because the tax code recognizes that sometimes you might have income coming to you that you would not have typically received in the year that you received that payment. So for example, there's a provision that allows you to say, hey, I received a payment for a lost crop in 2021, but my typical practice would have been to sell that crop, not in 21, but to sell that crop in 22. And so now I'm having to recognize income from the crop insurance proceeds in addition to the crop I sold at the beginning of 21. So I'm doubling up my income, which leads to that problem we discussed earlier, where we have income driven to a higher marginal tax rate than it otherwise would be. And so the tax code says if you can show that you typically would have sold your crop in the following year, you can defer the recognition of the proceeds of that crop insurance and not pay tax on it until the following year. And the same rule applies to disaster payments. So if you receive a WIP payment in the year that you incurred the crop damage, and you can show that you would not have sold that crop until the following year, you can defer recognition of that income on your tax return until the following year. But notice that I said only applies if you receive the payment in the year of the disaster. So I mentioned earlier that we had a new round of WIP payments that were authorized for the 2020 derecho, but those payments were not made until 2021. Because those payments were made in the year after the disaster, in the year after the crops were lost, there is no deferral available because already we've overcome that income bunching problem. So just keep that in mind. Again, it's an important provision to discuss with your tax professional. So I've told you an awful lot about provisions that you need to watch out for on the 2021 return. What I'd like to close with is just a little bit of discussion about tax policy, about some items that have been on the table in Washington all year long, about some headlines that we've seen from the spring through the summer in terms of significant tax changes that many in Congress were seeking to implement that may have impacted a number of Iowa farmers. And so what I want to close with is just a little bit of an update in terms of where are we at with tax reform in DC? Is it still pending? Will we have new tax law in 2022? And so I don't have any exact answers at this time. I'm recording this at the end of December, and at the time you're watching this at the end of January, there may be some more answers, but I'll tell you what we know right now. It has been the topic of the year in DC this year, because when President Biden took office, he made it an important part of his agenda to retool the tax code. And the pillars of the administration that were stated were to make the tax code more equitable and to implement more social spending programs to help lower income Americans. And so one of the ways that the president proposed to significantly restructure the tax code was to completely change the way that capital gain was taxed. So I'll give you just a little bit of a history, but spoiler alert, I'm going to tell you right now, these provisions are not on the table anymore. It does not look like these provisions, there is no way these will get through for 2022. So I'm telling you about them because it's kind of important to sort of let you know what actually reached to a level of serious proposal, to also sort of give you some update on some news headlines you might have seen throughout the year, and then just to sort of give you the status of what could possibly change for 2022. And so what the president had really wanted to do is eliminate the preferential capital gain tax rate. And so right now, and it's still the case, and it will be the case in 2022 as well, we have a maximum capital gain tax rate of 20%. And we may have to pay an additional 3.8% net investment income tax in some cases, but the idea is if I have property that I purchase and then that property appreciates in value, not through anything other than just growing in value. For example, I purchased a piece of farmland and I purchased it at $2,000 an acre, and then it's grown in value and now it's worth $10,000 an acre, right? $2,000 is my basis, $10,000 is the fair market value. If I would turn around and sell that farmland, I would have $8,000 in capital gain that I would have to pay tax on. And the tax code currently has a preferential rate when I pay tax on that. Instead of having to pay that gain at a 37% rate, which is the top rate in 2021, and it looks like it will be the top rate in 2022 as well for ordinary income. So if I just earn income, I have to pay 37% maximum if I'm over a certain income threshold. But for capital gain, the maximum rate I have for the federal government is 20%. And again, some people who are not active farmers may have to pay an additional 3.8% tax as well. But President Biden looked at that and he said, that's not enough. And so he wanted to subject capital gain that was more than $1 million to ordinary income tax rates. That means it would have been taxed at 39.6%, because his other proposal was to increase the top ordinary income tax rate from 37% to 39.6%. And ultimately, he also wanted to add the 3.8% net investment income tax to all sales, to all income above a certain amount. So ultimately, the top tax rate for sales of property that had appreciated would have been 43.4%. Now that is a hefty tax. And all of you out there who are listening can say, well, if I had a piece of property that had all that gain and I was going to have to pay 43.4% on that gain when I sold it, what would I do? Well, I would probably not sell it, right? And so the economists told President Biden and his staff, well, that's fine. You can implement this really high tax rate, but we'll tell you it will result in a lockout because nobody's going to sell anything if they can help it, if they're going to pay tax at a rate of 43.4%. So his proposal coupled a very significant provision that we've never had in the tax code before to take care of that lockout problem and to force everyone ultimately to have to pay this tax. And what his proposal was to say, hey, beginning in 2022, we would like to treat the transfer of any appreciated property at death or by gift as a sale. So in other words, under his proposal, which again is not going to pass, it's off the table, but it's important to understand what this proposal was, just looking down the road at potential future Congresses, at ideas that might come down the road. It's important to understand that this reached a serious level of consensus. A lot of people were in favor of this, and it would have taxed you at death. So if you had that $8,000 in gain and you died, instead of having the basis step up from $2 million to from $2,000 an acre to $10,000 an acre, and your heirs take over that property with $10,000 basis in the property, and nobody pays any tax, they would have had to pay tax on that $8,000 of gain at the time of your death. So that proposal was put out there. Again, it was proposed that there would be a deferral for family businesses, for family farms, where the tax for those groups would be calculated, but it would be deferred. It would not actually be due until such time as somebody in the family, probably meaning a son, daughter, a lineal descendant, was no longer farming it. And then that tax would become due. So again, that was just a proposal, but it was a very significant proposal, and it had a lot of support amongst the majority party. But really it was about August when enough lawmakers heard from constituents that said, we think this would be harmful to us. We don't think this would work. And so Congress pulled back from that and said, we don't have enough support to pass that proposal. So there was a significant reset in the tax proposals that were being looked at in Congress. And so the next proposal that came out of the House of Representatives would have also increased capital gain, but it would have only increased it to 25%. And it would have also included the 3.8% tax on a lot of gain as well. So in essence, the top capital gain tax rate would have been 28.8%. And I say would have because I'll say right now, so nobody gets confused, this is no longer on the table either. But again, you may have heard about this, and I just want to set the record straight. Yes, this was the next proposal, but it did not get enough support and it was pulled. But Congress would have increased the capital gain tax rate, and the economists looked at this and said, okay, well, yeah, that's a high capital gain tax rate, but we think people would still sell their property at that rate. So we think we'd still raise revenue from this. We don't think there would be a complete lockout like there would have been had you raised it to 39.6%. So there was no forced recognition at death event coupled with the increase in the capital gain tax rate under this proposal. The other provision that would have been significant to a lot of rural taxpayers, to a lot of rural landowners, was Congress suddenly decided, hey, what if we increase the tax base for the estate and gift tax? And how would we do that? Well, our current exclusion amount for estate and gift tax, which is totally different than capital gain tax. It's a totally different system. It is the idea that if you die with property, we should calculate the value of that property. And if the value of your property is above a certain amount, we're going to impose an estate tax on you. And if you try to give away that property while you're alive, we have a joint system where you'll pay a gift tax on the property that you've given away. So for a number of years, we have had a pretty significantly high basic exclusion amount, which means I can have in 2021 $11.7 million of property, and I will not have to pay any estate tax on that. I will only have to pay estate tax on property I own at my death that is more than $11.7 million. And if I'm married, my spouse also has $11.7 million exclusion. So we get to combine our exclusions, and together we have a very significant exclusion from estate and gift tax. In 2026, that increase, that amount will be lowered to $5 million indexed for inflation. And that's because this amount that we currently have was put into place by the Tax Cuts and Jobs Act of 2017. So this happened in 2018. In 2017, the exclusion amount was $5 million. In 2018, it was doubled to $10 million. And the reason I'm saying $11.7 million, and for 2022, that goes up to 12 million and some odd thousands of dollars, is because we have that amount indexed for inflation. But basically, the Tax Cuts and Jobs Act increased this exclusion through 2025. In 2026, that exclusion will go back down to $5 million indexed for inflation, which will likely be somewhere in the $6 million range. So when Congress was looking in September at what could we do to raise some revenue, they said, what if we lowered the basic exclusion amount back down to $5 million in 2022? And so that was a proposal that was on the table in September. They also had other provisions that caused some of you out there to meet with your tax advisors. There were a lot of land transfers that took place in 2021 with the thought that perhaps these provisions were going to go into effect. Well, ultimately, Congress did not put these provisions into effect, so these provisions were pulled off the table as well. But here's a little bit of a chart just to give you an idea in light of the fact that people have been talking about these provisions all year, just to remind us where the estate and gift tax exemption has been and where it is now. And as I said, for 2022, it'll be in the $12 million range. Congress does not have anything proposed as of the end of 2021 to change that. So for 2022, we should be in the $12 million range for this exemption as well. And in this range, really at this time, only 0.16% of farm operators would owe any estate tax if they were to die today. So, this amount that we currently have is fairly protective to the farm sector. When that amount goes back down, we'll have less protection. And so in your planning, just keep in mind the year 2026. In 2026, that is where automatically, if Congress does nothing else, the estate tax exclusion will go back down to $5 million indexed for inflation. So I mentioned those provisions did not make it into the final bill. So all of this talk, all of this hype, all of this action in DC all year talking about tax reform, what actually happened? Well, very briefly, in November, there was an infrastructure bill that was signed into law. And initially, the infrastructure bill was going to have tax provisions in it. But in the end, those provisions were taken out. So really, there were very few tax provisions in there. The only provision that really impacts those of you out there who have employees is the fact that the employee retention credit was eliminated for the fourth quarter. Any hope for tax provisions were shifted to what's been called the Build Back Better Act. And this is a bill that Democrats have hoped to pass via reconciliation, which would mean they would only need 50 votes in the Senate. But as we've seen, that has been a tall order because there is one senator from West Virginia, Senator Joe Manchin, who is not on board with the current provision that was passed through the House in what's called the Build Back Better Act. So what they finally settled on was a $1.75 trillion plan called the Build Back Better Act. It passed the House in November, but now it has to pass the Senate, and it has to pass the Senate with all 50 Democrats on board. And as of the time of this taping, they only have 49 senators who will vote yes for this provision. And what this would do is it would extend the child tax credit for another year. So that expansion that we started this program off talking about, the fact that it's only in place for 2021, if this doesn't pass in 2022, those advance payments that have been deposited into people's bank accounts would go away, and the child tax credit would be $2,000 for everybody, not $3,000 or $3,600. And this is a very big sticking point for Senator Manchin from West Virginia, because Senator Manchin has said that really this is proposing to extend the child tax credit for 1 year, which is how Congress was able to get at a bill that costs $1.75 trillion. But he says, you know that at the end of 2022, you will want to extend it again and again and again. So ultimately, the true cost of this bill would be closer to $5 trillion, not $1.75 trillion. And that's a huge contention that he has. He's also very concerned that putting this cash out there again throughout this year is only increasing inflationary pressure that we already have. So as of the end of 2021, with negotiations in the Senate, it does not appear that the Senate has the votes to pass the bill with these extensions of the premium tax credit, the child tax credit, etc. The only pay-fors in the Build Back Better Act are these listed on the screen. And you'll see that they're very different from all of the provisions that were suggested throughout the year. There's nothing in here to increase capital gain tax rates. There's nothing in here to increase ordinary income tax rates. There's something called a surtax on multimillionaires and billionaires, so that if you had more than $10 million of income, you would have an additional 5% tax rate added to your tax liability. If you had $25 million or more of income, you would have an additional 3% surtax. So you would have an 8% surtax on income above that amount. And so the idea of these provisions is to tax the very wealthy. It would limit IRA contributions. For example, if your balance of your IRA reached $10 million, well, I don't know anybody with an IRA that has $10 million or more that is an ordinary person. So again, the provisions that are in this Build Back Better Act that passed the House, the tax provisions would not have the significant impacts for the most part that earlier proposals would have. Now, there's some provisions for global taxation of very large corporations, etc. But bottom line, we don't know whether any of these provisions will go into effect because, again, just this week, and I'm talking to you on December 21st, just a couple of days ago, Senator Manchin said, hey, I can't support this. And again, if Congress does not have, if the Senate does not have the support of all 50 senators, they will not pass the Build Back Better Act. So as of this point, we don't know. My crystal ball is broken. We'll keep you posted. But bottom line, it's important for all farmers and ranchers to really keep up with what's going on out there in the tax world. We kind of saw over the course of this year that there could be provisions and proposals that go out there that if you don't speak up, if you don't talk to your representative about what works for you, what's helpful for you, what would be harmful for you, that there could be things passed that are harmful for you and your business. So it's good to be involved. It's good to watch. It's good to keep your person in Congress, your people in Congress, informed of what your needs are. So again, thank you for letting me kind of give you a brief tour of the tax code for 2021 and 2022, give you a heads up as far as what's going to be on that 2021 return that you're probably working to file right now, and just wish you the best of luck in the year to come. And reach out to our office at the Center for Agricultural Law and Taxation if you have any questions. Again, thank you for watching.